Welcome to CoreLogic's housing market update for July 2024. Australian dwelling values increased a further 0.7% in June, taking growth to 8% across the 2023-24 financial year, the equivalent of a $59,000 increase in the median value. The annual rise was in stark contrast to the previous financial year when CoreLogic's national index was down 2%. In that year, annual growth was weighed down by a 7.5% drop in values in the 9 months following the May 2022 cash rate hike. Despite the strong annual gain, the quarterly rate of growth has eased since the highs of mid-2023 when the pace of gains peaked at 3.3%. The most recent June quarter saw dwelling values rise by 1.8%, which is roughly in line with the March quarter at 1.9% and the December quarter last year at 1.8%. It seems the national index has found a groove, rising between 0.5% to 0.8% month on month since February. The persistent growth comes despite an array of downside risks, including high interest rates, cost of living pressures, affordability challenges, and tight credit policy. The housing market's resilience comes back to tight supply levels, which are keeping upwards pressure on housing values. Beneath the national headline numbers, the market's running at different speeds, but most regions are trending higher in value. Melbourne and regional Victoria were the exceptions, with values down 0.2% and 0.3% respectively over the month. Hobart has also shown weaker conditions, although values were relatively flat in June. Hobart joined Melbourne and regional Victoria, recording a subtle decline in values over the June quarter and down 0.1% over the financial year. Regional Victoria was the only other broad region to record a fall in values over the year, down 0.5%. Strong conditions have remained a feature of the mid-sized capitals, especially Perth, where values surged another 2% in June to be almost 24% higher over the year. Adelaide values increased 1.7% in June to be 15.4% higher over the financial year, and Brisbane housing values are up 1.2% over the month and 15.8% higher over the year. Regional markets have shown a similar trend to the capitals, with the regional areas of Western Australia, South Australia and Queensland leading the pace of capital gains, while regional Victorian dwelling values fell by 0.5% over the year and regional Tasmania recorded a mild 0.7% rise. The growth trends are reflected in the advertised stock levels, with the strongest markets continuing to show a severe shortage of homes available for sale. In June, the number of homes advertised for sale in Perth were 23% lower than at the same time last year and 46% lower than the previous 5-year average. Adelaide and Brisbane are also recording real estate listings that are significantly below the 5-year average for this time of the year. On the other hand, Melbourne listings have risen to be 14% above the 5-year average, and Hobart listings have been elevated for several years, now tracking 47% above average. Demand-side factors have also been influential, especially with interstate migration rates tracking well above average in Western Australia and Queensland and previously in South Australia. Strong housing demand, despite downside factors, is also evident in the estimated volume of home sales. Nationally, the annual number of homes sold was 8.6% higher than a year ago and 4.8% above the previous 5-year average. The largest jump in annual home sales relative to the historic 5-year average has been in Perth, where the number of homes sold last year was 29% above average levels. Moving to the rental market, growth is generally easing but remains well above average, with CoreLogic's national rental index recording a monthly rise of 0.4%. That's the lowest rate since September last year, and an annual rise of 8.2%, the lowest since November last year. The slowdown in rental growth is most evident across the unit sector of Australia's 3 largest capitals. Sydney's unit market has recorded the largest drop in annual rental growth over the past financial year, reducing by 10 percentage points to 7.1%. The annual change in Melbourne unit rents has eased from 14.9% to 7.5% in the same period, and growth in Brisbane unit rents has dropped by 6.8 percentage points to 8.5%. Despite the slowdown in rental growth across some markets, rents are still rising at an above-average pace across most regions and housing types. Nationally, the decade average for rental growth prior to the pandemic was just 2%. Brisbane dwelling values have continued to rise at a solid pace, up 1.2% in June, which is on par with the previous 2 months. In dollar terms, dwelling values are rising by just over $10,000 a month. The unit sector is showing substantially stronger growth conditions, with values up 10.3% through the first half of the year, compared with a 6.5% rise in house values. Rental pressures have eased a little over the past year, with the annual growth rate in rents falling from 9.4% a year ago to 8% in the latest financial year, driven entirely by a slowing growth rate in unit rents. Meanwhile, the annual pace of growth in house rents increased slightly from 7.7% in the financial year of 2023 to 7.8% in the latest financial year. An undersupply of housing remains the primary factor keeping upwards pressure on housing values, despite a growing element of downside risk. We can loosely categorise housing supply into advertised listings, which provide a measure of available supply, newly built homes, and rental supply. We could also add to the list social housing. Each of these components remain insufficient to varying degrees to cater for housing demand, which is why we're seeing values persistently rising at a time when interest rates and inflationary pressures are high, sentiment is deeply pessimistic, and credit policy is tight. Most cities are now seeing more new listings coming to the market as vendors become more active. Nationally, the flow of freshly advertised stock was tracking 10% higher than a year ago and 7% above the previous 5-year average. However, most of these homes are being purchased as fast as they're being added to the market, with total advertised supply levels nearly 17% below the previous 5-year average. The rise in new listings could be a signal that more homeowners are motivated or needing to sell. It's clear that savings accrued through the pandemic are now being drawn down for some households due to the combination of high cost of living pressures and elevated debt levels running up against interest rates that look set to remain higher for longer. Despite what's likely to be an increased level of financial hardship amongst households, the latest data from APRA for the March quarter shows mortgage arrears are rising but remain contained. The combined arrears rate reached 1.6% in the first quarter of the year, slightly lower than the arrears rate at the onset of COVID, which was at 1.8%. With inflation remaining high and the risk of another rate hike, or at the very least a longer period before interest rates come down, it's likely mortgage stress and arrears will rise further. The risk of financial stress is amplified by a combination of high household debt levels and loosening labour market conditions. Given the strong and broad-based rates of capital gain across the past 4 years, most homeowners who need to sell should be able to clear their mortgage debt. CoreLogic's latest Pain and Gain report highlighted the vast majority of vendors are selling their homes for a gross profit on resale, with only 5.7% of homes selling at a gross loss. That's the lowest portion in 14 years. Similarly, the RBA's latest financial stability review estimated only around 1% of home loans had a debt level higher than the asset value. Although the risks facing the housing sector are growing, we're still expecting home values to rise, at least in the near term. A material rise in new dwelling supply is likely to be a long time coming, considering approvals are holding well below average levels and barriers to construction, including compressed profit margins and scarce labour supply, remain significant. Until supply and demand rebalance, there's likely to be further upwards pressure on home values. We'll be keeping an eye on these trends along with any policy updates that could influence housing trends at the news and research pages of the CoreLogic website.